How to use Bollinger Bands. Ideal to use in times of market volatility. Market sell-offs, bouncing back, fear of recession. It all comes down to one word: volatility. Today, I'll talk about how to use a great tool to benefit from the stock market volatility and be able to take profits. If you'd like more content like this, please remember to hit like and subscribe. So let's talk about the Bollinger Bands. Assuming you have a brokerage account and have already in mind a stock to invest, you may want to use the Bollinger Bands. The Bollinger Bands work as a guidance to see support and resistance points, as the stock price will tend to fluctuate within the bands. The Bollinger Bands can be extremely useful to identify times of volatility and trading opportunities. When the price of a stock becomes volatile, the band tends to widen. On the other hand, when the stock price starts trading on a tight price range, the Bollinger Bands will contract or become narrower. Usually, periods of high volatility or expansion of the Bollinger Bands are followed by periods of contraction. Conversely, after periods of lower volatility, the stock may experience periods of higher volatility, which might represent a great trading opportunity to make a profit. In this example, you can see a stock that became volatile, leaning towards a higher price. Notice how the stock price traded within the bands, being the upper part the resistance and the lower part the support. You can also see that despite the stock price is closer to the upper band, it left all that empty space at the bottom, indicating the price range the stock had been trading at. Because of that, it is always a good idea to take profits right after the volatility period, when the Bollinger Bands start to contract, just to be on the safe side. You should always take profits at this point, instead of taking the risk of losing what you already made. Furthermore, you can use the Bollinger Bands to spot trading opportunities by seeing when the stock is actually overbought or oversold. For example, when the stock price gets out of the upper band, it may signal that the stock is overbought, and it could eventually go down. Contrariwise, when the stock price falls out of the lower band, it might be a sign that the stock is oversold, and that could mean an opportunity to buy, as the stock price could go up, and that means profits. The Bollinger Bands, as well as other technical analysis indicators, are useful in times of volatility. However, in my opinion, it is always a good idea to consider the company fundamentals, as well as other variables. Don't forget to watch the recommended videos. Thank you. Have a wonderful day.